Imagine waking up to see silver spiking above $108 an ounce, the kind of move that obliterates decades-long patterns and sends shockwaves through markets globally. Forget gold at $2,300 or $2,400. Silver, historically the smaller forgotten cousin, just broke a 50-year relationship with gold that almost every analyst on Wall Street thought was sacred. The gold-silver ratio, long anchored near historical norms of 60-80, just exploded lower as silver outpaced gold. Markets are scrambling, hedge funds are scrambling, and retail traders, most of whom were barely watching the metal space, are now asking the same question: what just happened? Let's unpack it. In the past 72 hours, silver prices have surged from roughly $76 to over $108 per ounce, a move of more than 42% in just 3 trading sessions. That's not normal volatility, that's a structural rupture. Meanwhile, gold has moved from about $2,100 to $2,300, or just under 10%, meaning silver's outperformance has dramatically compressed the gold-silver ratio. For decades, traders have watched this ratio, which divides the price of gold by silver, hover between 60 and 80 in long cycles. Today it's crashed toward 21, levels not seen since the early 1980s silver bull market. This isn't just a technical quirk, it's a tectonic shift. What's more, open interest in COMEX silver futures has spiked to record highs, while exchange inventories, particularly in London and Shanghai, have tightened sharply. ETFs backed by physical silver have seen massive inflows, swelling their holdings by millions of ounces in a matter of weeks. To get a sense of the scale, COMEX silver inventories are down more than 30% year over year, while SLV, the largest silver ETF, has added over 200 million ounces to its vaults in the past 4 months alone. Those numbers are massive relative to annual mine production, which sits around 800–900 million ounces globally. So what we're seeing isn't a minor market wobble. It's a bifurcation where price, positioning, and fundamentals are all pointing in new directions simultaneously. Let's break down the market currents that brought us here. Futures markets. In futures, the story has been one of relentless positioning. Net length in silver futures among managed money, that's hedge funds and large speculators, has shot up to multi-year highs. Meanwhile, commercial hedgers, typically producers and refiners, have been reducing short positions, signaling they expect tighter physical markets ahead. Price discovery in COMEX has also been notable for widening bid-ask spreads and increasing volatility, especially during Asian and European sessions, a classic sign that the market is struggling to find equilibrium. Physical supply dynamics. It's here where the real story gets interesting. Global silver supply has been tightening for years. Mine output has stagnated after declining in Mexico and South America, while recycling hasn't filled the gap. At the same time, industrial demand, which accounts for more than 50% of total silver consumption, is skyrocketing. What's driving that industrial demand? Solar panels, electric vehicles, 5G infrastructure, and high-end electronics are all voracious consumers of silver. Solar demand alone is projected to consume more than 200 million ounces annually, up from under 100 million just 5 years ago. And EV battery tech continues to increase silver loadings per vehicle. You combine tightening production with surging industrial demand, and you get a supply deficit, a persistent multi-year one, according to the latest industry reports, on the order of 100–150 million ounces annually. Technical levels. From a technical perspective, silver's move through key resistance in the $90–$95 range triggered a cascade of stop-loss buys and breakout strategies. Once price cleared $100, we saw an acceleration that defied typical retracement behavior. That's the market telling us there's real liquidity on the bid, not just headline trading. The next resistance clusters, psychological zones near $115, and then the all-time highs around $140, $150. But remember, once price breaks a long-standing pattern, historical technicals often matter less in the short term than the fundamental drivers behind the break. Institutional positioning. Institutional positioning is perhaps the most telling part. For years, big banks and macro hedge funds were underweight silver, citing its historical volatility and cheapness. But now, speculative gross longs are higher than at any time since the 2011 silver peak. At the same time, dealers are reporting record off-exchange physical sales, meaning even institutions that don't trade COMEX futures are accumulating metal for delivery. One powerful metric, the Commitment of Traders report, shows that managed money net longs in silver futures just eclipsed the 2011 peak, a sign of seismic positioning change. Now let's elevate the lens and look at the global macro backdrop that's becoming impossible to ignore. Federal Reserve policy inflation has proven stickier than expected. Even as economic growth slows, services inflation remains elevated. The Fed has reacted cautiously, keeping rates higher for longer rather than cutting swiftly. That policy dynamic lifts real yields a bit, but it hasn't doused inflation expectations, and that's bullish for precious metals, which are traditionally inflation hedges. So while gold has benefited from the store of value narrative, silver is catching both inflation and industrial demand tails, a rare dual driver configuration. Inflation and currency markets beyond the US. Emerging markets are grappling with weaker currencies and capital outflows, pushing investors toward hard assets. Silver, in many cases, trades at a discount relative to gold, particularly in Asian markets, making it an attractive alternative for those seeking real asset exposure. The US dollar itself, while not collapsing, has been range-bound amid divergent global monetary policies. A stable or weakening dollar mechanically supports commodity prices, silver included. Geopolitical instability, supply chain disruptions, from mining regions in Latin America to refining bottlenecks in Asia, have repeatedly flared over the past few years. Geopolitical tensions in key mining nations and export controls on critical refining capacity have exacerbated supply rigidity. That's especially true in silver because, unlike gold, a significant portion of supply is a byproduct of base metal mining. When copper and zinc output falters, as it has, silver production gets inadvertently choked. Global supply chains add to this the fact that industrial demand is coming from every corner of the global economy. Solar modules from China and Southeast Asia, EV components from North America and Europe, and electronics everywhere. Supply chains still aren't fully normal post-pandemic, and that's tightening the physical metal flows. All these global forces converged into the perfect storm that produced this price event. Now, and this is critical, silver isn't just one market. It's two markets that frequently disagree. Paper markets, futures, options, ETFs, and derivatives. Physical markets, bars, coins, industrial offtake, and vaulted metal. In paper markets, price can move rapidly on leverage and sentiment. The physical markets are about delivery, storage, transportation, and real supply. When paper traders are massively long but physical availability tightens, something interesting happens. Premiums blow out. And that's exactly what we're seeing. Physical silver premiums in major hubs like Singapore and Zurich are spiking relative to the spot price on COMEX. Delivery queues are lengthening, dealers are rationing metal, and institutional players that once treated silver as a trading vehicle are now building inventories. Why does this matter? Because at some point the physical scarcity will inform or even control the price in the paper market. We saw this once before in the late 1970s and early 1980s. When physical backing became hard to secure, price moves became explosive. This divergence is not just an academic observation, it's a structural tension that could shape prices for years. Let's step back. You've likely heard comparisons to 2011, when silver peaked near $48 and gold around $1,900, driven by fear of inflation and massive ETF inflows. But today's environment is different. Then the surge was predominantly a liquidity story, cheap money flooding into assets. Now we have genuine supply deficits combined with real industrial demand growth. The most instructive historical analog might actually be the late 1970s cycle, when silver went from under $5 to over $50 amid inflation, geopolitical instability, and genuine bullion scarcity. Of course, markets never repeat exactly, but they often rhyme. And right now, the rhyme is this: scarcity meets structural demand, meets macro uncertainty. So where does this go from here? Let's walk through two clear paths. Bearish scenario. Why prices could fall. A bearish outcome isn't impossible. If industrial demand slows due to a global recession, or if the Fed aggressively cuts rates and ignites a rally in the dollar, silver could see a retracement. Technical exhaustion alone can trigger profit-taking. If prices fall back below $95 and major technical buyers step aside, we could see a move down toward $80 or lower, especially if leveraged funds start de-risking. Another bearish factor, if physical premiums normalize quickly and inventory builds, particularly in COMEX warehouses, the scarcity story loses credibility, reducing the catalyst for further strength. Bullish scenario, what could trigger a major rally on the bullish path? The supply deficit deepens. Imagine more mine closures, prolonged refining bottlenecks, or export curbs from major producers. Those events could tighten physical further and force even short paper positions to cover. Add in accelerating industrial demand, especially solar and EV adoption, and we could see silver trade well above historic highs. A run toward $150, $175, even $200 isn't out of the question in a world where scarcity meets aggressive accumulation. More importantly, if the gold-silver ratio continues compressing, silver could vastly outperform gold, attracting crossover flows from traditional precious metals investors and macro funds seeking asymmetric returns. Here are the numbers every serious investor should be watching. Price levels $115, $120, near-term resistance zone, all-time highs, $140, $150, critical psychological and technical barrier, support near $90 and $80, important downside pivots, ratio gold-silver ratio, breaks below 30 could signal structural market rewiring, inventory and supply, COMEX silver inventories, ETF holdings, GIO PSLV, SLV, refinery backlogs and delivery queues, mine production reports, macro indicators, inflation data, Fed rate decisions, dollar index trends. So let's wrap up with 3 big points you should remember. 1. Silver just violated a decades-long structural pattern, and such breaks are rare and meaningful. This isn't noise, it's a regime change indication. 2. The fundamentals, especially supply deficits and surging industrial demand, are real and measurable. This isn't speculation, this is structural recalibration. 3. The divergence between paper and physical markets can't be ignored. When physical tightness eventually forces paper markets to adjust, volatility and opportunity tend to accelerate. As always, markets don't wait for consensus. They move first and ask questions later. Silver's dramatic break isn't a footnote, it's a signal. Whether you're a precious metals veteran or a macro investor watching from the sidelines, understanding these dynamics will be essential for navigating what comes next. Stay curious, stay disciplined, and above all, think independently. Because history doesn't repeat, but it often teaches. This is a story far from over, and trust me, the market will keep speaking. Are you listening?